After reporting first quarter earnings results, Foot Locker's stock price crashed because of the disappointing figures. Now I know you're probably thinking, is the dip a buying opportunity? So in this video, I'm going to answer that question. But first, I'm going to review Foot Locker's latest earnings results, and then I'll answer the question if this dip in the stock price is a buying opportunity. So let's begin. So for Foot Locker, revenue decreased by 11.4% to 1.9 billion. That was a bigger decrease than management was expecting. Earnings per share also collapsed to 38 cents, down from $1.37 in the same quarter last year. It was a double negative downside for Foot Locker in the quarter. Not only did sales fall, but sales would have fallen further if the company hadn't undertaken significant markdown strategy. Inventories built up to 1.76 billion. That was up from 1.4 billion year over year. The company has a lot of inventory on hand, and unfortunately, it's the kind of inventory that customers don't want right now. So management is taking aggressive markdowns to try and sell that inventory to raise cash and to boost sales. Right now, they're struggling to get rid of that. Longer term, they're in a worse position also because one of their primary partners, Nike, is taking a strategy of cutting out wholesalers, right? Partners like Foot Locker, Nike is trying to reduce the inventory they send to Foot Locker. Why would they do that? Well, because when Nike sells inventory to Foot Locker, they sell it to Foot Locker at a lower price so that Foot Locker can then resell it and earn a profit for its services. But if Nike was to sell direct to consumers through its app and its website, Nike generates higher profit margins in that way. So that's the long-term strategy that Nike is taking, and it's told investors they're going to continue on that path. So they're working to reduce the inventory they send to third parties like Foot Locker, like Macy's, and their other partners, and they're working to increase their sales on their own channels. Well, that's a significant driver of Foot Locker's sales, and without that and reducing that, that's going to hurt the company longer term as well. So it's not just the near term that's troubled for Foot Locker, the long term is also troubled for this brick and mortar retailer. Cash flow from operations in the quarter was negative 118 million. That's worse than the negative 21 million in the same quarter last year. And that's mostly due to rising inventories. Inventory is a use of cash, right? The company pays money to get inventory. And while inventory is sitting on its shelves, it's not generating cash. So when it sells it, it can raise cash. But right now, it built up those inventories, and so cash flow was negative. Because of this disappointing quarter, management lowered the target for 2023 to revenue falling by 7.25%. That was worse than the negative 4.5% in the prior forecast. The company also lowered their earnings per share target to a range of $2 to $2.15. This was down big from the previous target of being $3.50. So across the board, bad news from Foot Locker. I can understand why the stock price collapsed in the aftermath of these earnings results. And to answer the question I posed in the headline, is this stock price decrease a buying opportunity? My answer is no, it's not a buying opportunity because I don't believe that these headwinds are short term in nature for Foot Locker. I think Foot Locker's troubles are longer term in nature because it's primarily a brick and mortar retailer, and it's one of its main partners, Nike, is working to reduce the amount of inventory it sends to third parties like Foot Locker and the group of companies that Foot Locker operates. So for that reason, I don't believe this is a buying opportunity. All right, thank you so much for watching. I hope I'll see you again soon. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.